I'm going into details and I'm giving you applicable, examples. So it will be slightly different. Okay, the swing low and swing highs. All right, depending on whether you have a downtrend or an uptrend. Okay, so this is the heart of forex, because I'm going to be taking you into the market, and I need you to understand that what defines a trend is that thing that Dow talked about. There's no point making your trading strategy difficult. He says if you have two successive swing highs like this, right, you have a trend. What makes this a swing high is the moment where this thing now goes higher than this one. Once it goes higher, it becomes a swing high. And then I need to say emphatically, what has to exceed this high is the body of the candle. Is that okay? You're going to see something called fading breakouts. There are sometimes the market just goes to a previous high, and then it just currency trend meter from indicators. So even if you use something that is as simple as the latest swing on a chart, you're going to have a fairly stable and reliable, strength, outlook of the entire market. So we'll get to all of that today. So we have a lot to do today. Let's go gradually. So it's passing through the low, not like this, right? This is not a pivot point, is it not? It's right here and not here. So if you see, this is wrong. Okay, because when you open your chart as a beginner, you look at the chart, you might be confused. Okay, it's easy for older guys to understand. All right, well, beginners can say, okay, I've drawn best fit. You don't do best fit, right? You don't do best fit. What you do is the swing low. So you are after the swing low. If you look at this chart very well, what you will observe is that what you observe here is that, before all of this appeared, right? Before all these things started to happen, the traders would have kept their trend line here, is it not? Here. Is it not? Yes. So what happens? Now, the moment they put a trend line here, that trend line gets broken. Okay, so you see that sometimes a break of a trend line might not necessarily mean, when we do reversals, that there has to be a break of a trend line. But that you have a trend here and it's broken doesn't necessarily mean that the trade must reverse. There's something we call expansion of a trend line. I'm going to teach you when we get to trend lines, right? Expansion of a trend line. That is exactly what happened here. Now, what traders do is, this line, of course, is no longer valid, right? Whatever line they're going to have here will not be valid anymore. There's going to be something like a line here, right? So that line will not be valid anymore. So what do? Now, the market has started falling down. The moment the market breaks this high, it now validates this as a swing low. Do you understand? I'll take it again. This line is not existing yet. The only line that is existing is this one. Now, the market is now going down, right? It stalls here and starts to resume. Is that okay? Yeah. It starts to resume. Now, I'll tell you what. If it is not the body of the candle, the red and the blue parts that you can see clearly, that has broken this high, it is not valid. Do you understand? If it is just something like this week here, if it's something like that went high and just turned back, it's not a swing high yet. Is that okay? So it has to be the body of the candle. Yeah, it's the body of the candle that makes it valid. Now, what traders do is they continue to watch, right? As the market resumes, once it goes and then it goes higher than this place, they will now connect this line like this, right? So traders might have, because this market turned like this and started to go like this, and then maybe later on they are seeing this, they now say, okay, these two are matching each other. Is it not? They can say this is best fit. Is it not?
Yeah.
Because they are looking at this point, they are looking at this, So, but you don't do it like that. You have to pass through the swing low. At a point, this was our swing lows, right? So we use here. Then later, we now have this as swing low. And the reason why this became swing low is because it passed on this top here. So once it passes on this top here, it becomes the next valid swing low. That's exactly what was, drawn here. So we remove this one, and then we draw this one. And you know what traders are doing now? They are waiting for the market to come back to touch that line. And then it offers an opportunity to buy. So the thing about putting this kind of swings is that usually they don't happen very often, except maybe you go to a lower time frame. They don't happen very often. There are things like this are for swing traders. And remember the thing, it's not go that day. I don't know if you understand what I'm saying. It might not go to your target that day. Okay? So I'm not saying that you can't use this. I'm just telling you so that you take note of it. So if you're doing it, you don't come to, if this is a daily time frame or H4 time frame or even H1, right? Okay, H1 might work, right? H1 might work. But if it is H4 will not work. You have to know who you are. Let me go to the slide where we talked about. That's exactly what I told you guys, right?
We
So
jumped
really,
Yeah, that's true.
okay. So if you're a position trader, you're looking for around 500 pips. That's the kind of move Bitcoin gives. 1,000 pips. So, and this thing doesn't happen in a day, right? So if you're a position trader, you are trading on the daily or weekly chart, and then you're looking to hold your trades for as long as weeks to months. So yes, to get that kind of move. Because it means also that you are a kind of trader that doesn't mind the market going against you. Is that okay? So you are okay, you are comfortable with the market doing like this, doing 1,000 pips. Right? So you got to know how to follow up. Right? Swing traders look for 50 pips. That's what I was trying to say with that trend. They look for around 50 to 150 pips. So swing is catching the resumption of a trend. That's swing trade. You have maybe connected a trend line and you're hoping to catch another swing. These things are called swings. Those legs are called swings. So a swing trader's goal is to find himself in one of these kind of move. That's a swing trader, right? And then when this thing happens, usually you can get around 50 pips or more, right? So, and swing traders would they normally will use a 1 hour or 4 hours chart. Usually 1 hour, 4 hours. They do the analysis on the higher time frame, which is the daily, and then they come to 1 hour or 4 hours to take their trades. And that kind of trade will last for usually around 3 days, 2 days, 3 days, but generally less than 1 week. A swing trader, as a matter of fact, as you're trading now, don't hold rule. I don't think I mentioned it the day I talked about it. So you cannot hold a trade over the weekend. So on Friday afternoon, you close out all your positions. There are several reasons for doing that. One, yes, whether in loss or profit, you have to close it. It is their rule that you don't trade when there's weekend. Then when you have the real money, you don't trade 5 minutes to and before a news release. So they will inform you that there's a news release whenever there's a news release. So you know what time the news release is coming. So you don't, I told you news releases are they are gambling activities. So they don't want you to gamble, right? So it's unless you have a position 6 minutes before that news release, right?
So that consistent.
Stay running.
Sorry? Yeah, you can allow it to roll. While the news, of course, you can't start closing whenever there's a news. So, but not like you are aiming to buy, sell at the market when a news is about to be released. 5 minutes is a rule. They will send you a mail containing all those rules. So you don't do that, right? So the intraday traders, those guys are, majority of us fall into intraday. Okay, and intraday traders use usually 15 minutes most times, and then 1 hour. Okay, 15 minutes, 1 hour. If you find some people stay on 30 minutes, but I like to use either 15 or 1 hour because I want to see some difference in some relative difference in the chart. Okay, because I prefer to look at 1 hour relative to 15 minutes. Okay, because I'm going to have 4 candles on 15 minutes, right, relative to 1 hour. But I'll have 2 candles on 30 minutes. Is it not? Yeah, so that's why. So there's nothing personal really. It's just that I like, if we had a 2 hours chart at our convenience, I wouldn't mind using 30 minutes. Is that okay? Yes. If we had a 2 hours chart, because I'll have as much as 4 candles. Yes. So it's just to have the market broken down. When you go to a lower time frame, it's broken down. You see all of those things today. Then scalpers. I told you that you have no business scalping, right? You have no business scalping. You're not scalping anytime soon. You need to have traded for at least 1 year before you think about scalping. Okay, so you have, and in the course of this 1 year, you have been doing so many things. You have been trying systems, and you have, of course, you started by having a particular system that you are trading. So, but you don't stop learning, is it not? You don't stop learning, and then you have observed the market to a point where you feel that, okay, this is what can work. Because if you don't listen to what I'm saying now, you are going to end up throwing away all the money that your intraday trades and swing trades have given you on the scalping table. That table is very risky. It's risky because you are facing your emotions directly. That's why it's risky. And we usually cannot outsmart the market. So when scalpers are scalping, right? Because candles are going against you and in your favor. Open a chart and try to scalp and see what I'm saying. Candles are going against you and in your favor, against you and in your favor immediately. When you take a swing trade, it takes time before it starts to go against you if you are right, Abi? But when it starts to go against you immediately and you have a lot of money exposed, you're going to do it the wrong way. So there's a course we're going to take that's going to cover scalping or cover for scalpers. All right, so I'll teach you under money management how to manage your money depending on what you're doing. Okay, so for scalpers, there's just a standard lot size and a maximum. They don't do lot size the way we do it. They just take a currency pair and take a gap, right? Maybe 10 pips or 5 pips. Okay, and then they take targets, maybe 10 pips or 5 pips target. Right? So that's the right thing to do. When we get there, I will show you. Okay? So you don't have to scalp. You shouldn't scalp. Scalpers look to make around 10 pips per trade. Okay? If they get 5, they are okay. Alright, the thing is that they are using a big lot size. Abi? Just use, scalping like that. There's a book by Bob Vorman on scalpers. It's on the Telegram resource group. You have to read it. So it's not part of this course, right? So you got to read that book, finish it before you even think of scalping. 10, 92, 10 something, 150 on very volatile days. Okay, so that's how far up and down the market will move in an entire day. So if the market is going to cover a total distance of about 80 pips in a day, right? Traders are looking to, catch around 40 pips. Okay, so and you cannot have a target of of 100 pips when the market's ATR is 80 pips, is it not? Except maybe you have other trades and then you add up all the number of pips you made that day. Okay, this again is the reason why I was telling you that if you're going to work with Blue FX, you have to design a system that allows you to make a lot of pips. And you have to know what kind of trade you have to make. You cannot be a scalper and succeed with Blue FX. Are you aware? It's impossible. Because you can't use leverage. Leverage is 1:3. You can't take big trades, and I mean you cannot go for small targets. You can't go for 5-10 pips when your target, your minimum is 1,250 pips. So if you're taking 5, you're going to take about 60 successful trades within 20 days. Okay, and then we have not considered your losses. Right? So you can scalp. The only thing you can do is either swing trading or intraday trading. And if you're doing swing trading, you have to make sure you have good trades, because you have how many weeks? You have just 4 weeks. You have 4 weeks. 20 days. You have 4 weeks, 20 days, and then you are targeting around over 1,000 pips. And then let's say on the average you are making 100 pips per trade. It means that you need as much as 13 trades, 13 good trades without any bad, or let's say your P&L has to be 13. The difference between your profit and loss has to be 13. If you win 26, you cannot lose more than 10 or 13 rather. Yes. If not, you won't meet up. Okay? So you're understanding this thing, right? So when you go, you know what approach to use. So when we talked about this slide was when we say you got to decide what kind of trader you want to be. Okay? And then if you're deciding, of course, you got to know what your target is. You got to know what your trade duration is and what kind of charts you will do your analysis on. It would be ridiculous for you to be an intraday trader and you spend all morning looking at a weekly chart. Okay? Or you are an intraday trader and you come to 1 minute time frame. You are not scalping, so you shouldn't be there. Alright? It's clean. Okay? See how the market is respecting it. And then somebody will see this and say technical analysis doesn't work. I mean, I can't understand. If the market, if I am a trader and I put a line here, one, and I put another one here, and the market went here, didn't get to the line. This thing is called an undershoot. Came down, but came back to the line. That line is a magnet. I'm going to teach you. It's magnet. There's a magnetic field around that area, around that line, that sucks the. Okay, so you can see how it's sucking it's trying to pull back the price, right? It's pulling it, okay, because traders are looking at it, and then there are others. People are buying. If this thing is 1, 2, 3, 4, 5, 6, 7, 8, 9, people are saying, I want to sell from 8, or I want to sell from 9, or I want to sell. So the market has to go there, pick their order, and sell. These things work. Trend lines, they work, and they will continue to work. The only thing you just need to know is how to time your entry correctly. You put a trend line. This is where the magic is happening. In front, not here anymore. In front, you're waiting to see how the market reacts to it. Once the market comes to it, and then it gets to that point, you're looking for entry signals. Your entry signals are usually reversal candles. And of course, if the market is coming here, why do you need a reversal candle? You need something that will tell you that the market is turning. Look at all these points. There are reversal candles in all of them. All. Once the market gets to that line, it will print a reversal candle. And you know how much the market will give you? It will give you at least king of these lines. You have to draw a trend line that other traders around the world also drew. If I open my chart and I open your chart I shouldn't see any difference. If you come now and I say, okay, mind you, what we connect on the opposite side is called what? Trend channel line. So, of course, if I try to connect it now, you now see that it puts it in a channel. Is it not? Puts it in a channel. And usually serve as a point for taking profit. Yes, please. Now, on this platform, ECN gets feed directly from the market. But you are aware that there's something called the spread. Difference in price. Now, if you're working with broker A, I might be filled at 10 naira 20 kobo, but you will be filled at 10 naira 22 kobo or 25 kobo. It's still around 10 naira, but there are some differences. Now, all these things will eventually cumulatively print on the chart. So we are taking this reversal area as a zone. But when you design a trading system, you cannot be subjective. So when I design a trading system, I follow the wick. Because there is something I'm going to teach you, it's called undershoots and overshoots. The market, this thing you say some will go up, some will come, those things are overshoots. If the market touches a point, if the market is going up, and then it touches a point once, right, and twice, and then it has beaten the previous high. Traders have high, low, swing high, two swing lows, and then highs, right? Market starts to reverse. Okay? Now, if I'm designing a trading system, I'm not going to have that issue. I won't be asking myself whether to use the body or the wick. I must use the wick, which is the wick is like saying this is the highest the price has done.
Or the lowest.
The lowest. So I can't be wrong anymore. The only thing is the market might not get to my line at that time, but it will eventually come back and get to my line. Right? Yes. So the safest thing to do is to follow the wicks. But if you want to look at it and say, okay, this is this area of reversal, depending on what you are trading, right? You can now say, okay, touch wick here, touch body here. But if you're designing a system, you want to write it clearly that you put it across the swing low. And if you say swing low, if there's a wick here and you ignore that wick, do you know that if you have an order here and the market gets to that point, the order will be filled? So you can't ignore wicks. I don't know if it makes sense. Wicks are not to be ignored. The market got there. There was trading activity here, even if it's for a second. If you have orders here, it will get filled. So when we draw our line, we have to take it into consideration because the computers do. Computers are designed to follow the wick, not the body. Right?
So it should be the tip.
Yes.
Of that,
yes.
that wick.
From the tip. So you go like this throughout, and then it will save you a lot because when market touches the tip twice, it will usually come back the third time to do what we call an overshoot. That overshoot is designed to take away people who traded the undershoots. There are people who follow the body to place their trades. So when this guy comes, he will dip lower such that those that traded the body and all of that would have been stopped out before the move eventually starts. Right? So now, you who have followed the wick, this dip now becomes what I call an overshoot, which is there are only 2 times when traders should trade reversal. Only 2 times. You might learn something else somewhere else. But for me, the only time I can trade a reversal is when there's an overshoot or a major trend reversal, which is the break of a trend line and a retest. So we'll get to all of that. So just take note of that and keep it somewhere. You see what's happening here, right? You have 1, 2, and then the third time usually offers an opportunity for trading. Is it not? Even if this is an undershoot, if you adjust this line properly, I believe you should make this. Okay, so the point is, trend lines offer opportunities for you to know where the market is giving you a discount. Okay, because if you say, oh yeah, the market is in a downtrend, you see the market going down, right? You say it's in a downtrend. You got to know where to enter from, right? Because if you see red bars and you just get in here, I told you that institutional traders will, instead of selling this market from here, they won't trade throughout that day. The market has to come back to a discount level. It's like going to buy something that you want to resell, and you are buying it expensive from a boutique. Maybe you buy them 15,000 from a boutique, then you bring it to your neighbors. You can't sell it. That's what it is. When you try to buy it somewhere around here, you're buying it 15K. You have to go to Alaba, or where do people buy shoes? Aswani, wherever. You go there and buy it cheaper. You will hardly be wrong about it, because the market won't pull back forever. Are you aware? See, the market, when the market is looking to you like it's selling, that's the time to sit down and wait for a buy opportunity. I don't know how to explain this so that you don't misunderstand me. But when the market looks like it's buying and you buy, you are wrong. I told you that if you are certain about it, don't take the trade. Is it not? If the market is selling, if the market is selling like this is the wrong time to sell. Are you aware? The right time to sell is when it starts to buy. Does it make sense?
Yeah.
You get to it. You get to it.
From point 2 there, if one is to sell, like on that line, the blue bar before the long red bar, you know, the blue bar is buying. So
yes.
if we have set our entry on that line, are we to set? My question is: are we to set our entry on that line, waiting for the buy candle to touch that line?
Well,
open it with
in this extract I have, the bars here didn't actually touch the line, right? This is a case of undershoot. Okay, if your trading strategy is designed to allow you to take it like this, then you can take it. But if it does, like my own doesn't allow, and the reason is that thing I talked about, trading journal. When you keep a trading journal, you see the trades that didn't work out well, right? Then over time, you just remove it from your style. It can float and you accept it. But if it's a dynamic, why we can accept that one is, some people can decide to use moving average that has a period of 20. Some will use 18, some will use 10, some will use 5, some will use 21. So if it doesn't get to my own, it's still okay. But if it's a static line like this, I want it to get to it. I'm usually objective like that, because you don't want a situation whereby this thing offers enormous opportunities. And again, for the so much for the accent. You have it right here. You can see the wick, not the body, the wicks. Okay, the wicks. Because if you do the body, the market will come down to violate for those that have done, the body. Those that did the body will have their lines somewhere around here. And you can see how the market messed it up. Okay, and when that happens, this thing you see here is called an overshoot. Right? Do you see that red? The tail of that red. Overshoot is pam overshoot. There's overshoot with indicators. I don't use it. They use oscillators to do overshoots and indicator that the market is oversold. Once it touches 1, touches 2, the third time it comes and then it closes above the line. It's an overshoot. Just buy. Overshoot and the undershoot. The place labeled overshoot. I have overshoot on the top and on the base. You understand what an overshoot is now?
Yeah.
It's an overshoot. It's like it's exceeded its maximum, limit.
Now realize it.
Yes, it now realized itself and came back.
Anyway,
But is it
that's
program?
actually that's actually what I want that came into my mind. Since it goes down, it should be under.
No. Undershoot is below target. Overshoot is above target. It doesn't mean that undershoot or overshoot is if I am this, I have overshot.
Okay, yeah.
If it's the upside, if I'm supposed to stop here, and then I now go and stop here, this is an overshoot.
Okay.
An undershoot is if I'm supposed to stop here, I now stop here. It's an undershoot.
Okay.
Same thing here, undershoot. I didn't get there. It's an undershoot. If I exceed it, overshoot. So that's what those wicks would normally do. This thing I just said is a powerful strategy. If you look for overshoots for your swing trades, you make money repeatedly. That's the only time I trade reversal. Overshoots or major trend reversals. Do you have a question?
Yeah. I'm just confused with this overshoot.
Yeah.
So my question is.
Yeah, now we have these two as swing lows. The moment these candles formed, right, broke it, and then, of course, once this high is violated, we have this as a valid level for us to connect a trend line and wait. All of this has not happened, right? But we have our line, and we are waiting. So we want to see how the market will react to the line. And then the moment the candles get to that point, what do we see? The red candle was, at some point, it was a full red candle that was below the line. But towards the end, it was rejected and then it closed above the line. That's the overshoot. Yes. So the overshoot means that this thing has exceeded its limits. It's not supposed to pass this line, just like these other guys. It's not supposed to pass this line. So the overshoot is passing the line. That's the problem. So if we call it an undershoot will be
Not getting.
yes, not getting to the line, like this example here. It didn't get to the line. So it's an undershoot.
Okay, so but all these candle lines now are being drawn based on what the market is, what is happening in the market.
Yes.
Which
Yes.
I have not bought, I have not sold.
You have not bought, you haven't sold.
So it's just the
You're just
markets.
looking at it. Now, what we are saying is that this will offer you an opportunity to buy.
Yeah, but
And then the stop one tick below. And then you allow it to go at least 1:2 of that height of candle. Yes.
I want to know if this trend line is another strategy.
It is.
It's another strategy.
Yes.
Aside from my parabolic size.
Parabolic SAR is a strategy on its own. That's different.
This one is also a strategy.
You can have up to 1 million strategies.
Because I'm finding it difficult to trade with this, even when you taught us last year.
Yes, I know. That's why we're having this 2 months class. Is it not?
Yes, this
Because-
is price action, right?
This, yes. So we're now going into details. And the last time, I'm sure I didn't show you all of this information. Yes.
I want to ask, when,
Stay here.
so when it's only the week, it only violates but it doesn't accept.
Yes, it goes and is rejected. So you can't outrightly accept it. So yeah, you got to do what the computers are doing, really. Yes, and where it's actually closed.
okay, so the red one, the red and the green one, what's the difference between the red and the green?
I'll talk about it. We have one slide, the 5-wave move. Okay, then we now saw that these things respect a particular line. All right, they usually will say it's a self-fulfilling prophecy. When traders put this line, it goes, comes back, it respects it. It goes, comes back, it will respect it. It's a trend hyping it. Okay, so they are not actually robots, but they code them with a mathematical statement. Okay, and that statement is a simple calculation. There are statistical data that they compute together and then they plot them on the graph. So, see, let me show you what moving average is when you say average, it is still average. The difference now is that it is what? Moving.
It's not static.
Yes. So if I give you a collection of data, if I give you numbers like the math teacher will give us, maybe 5, 6, 4, 5, 5, 8, right? Something like this. Then we have, here we have 6 numbers. They will now say find the average of the following numbers. Common entrance. Is it not?
Yes, sir.
Now, what you will do is, you will now add up all these numbers and divide it by how many they are. Right? Over 6. So you say this plus this plus this plus this plus this. Right? You have the answer here. Divide it. Then you now have a number that is the average of all of these numbers. Is it not? Now, that's what moving average is. The only thing or the only difference is that moving average will delete the oldest price and add the most recent one that just closed. Is that okay? Moving average will delete the last one and add the new price, today's price. If all of this is a distribution, if I'm on a daily chart, let's say this is a daily chart. And okay, we even have daily chart. Daily chart means that this is the price of the market candles in details when we get there. So, but just understand that the candles represent how high or how low the market moved throughout that day. Now, the moving average is usually having what we call a period. The period now is, for us here, we had 25,000. Day before yesterday, 24,500. 3 days ago, 26,000. 4 days ago, 38,000. It will take all those prices, add them together, and give us the average. Right? That average amount, it will plot it on the graph. Now, the next day, when today's price comes and the market closes by the end of the day, we are going to have today's price. So it will now take it as part of the data and remove maybe last week Wednesday's own, right? And add today's own to show us the new average price. That thing continues like that. So it will now have all those prices, and then the thing is designed to connect it as a line, a single line. So that's the line that you can see on this chart here. So if you look at it now, you can it's just like the one I said before, it's just like even saying something like this, dots. As the candles are, so but this type is the one that is connected together. You know, it's not allowed to float. I don't know if you get what I'm trying to say now. That's not exactly what this one is. Okay, but I'm just using it to explain these dots. Alright? So the dot, what you see is, if the market starts to fall down very fast, because it's an exponential market, it is falling down very, very fast. What you now observe is that the moving average will now start to turn down. Right? It will start to turn down. If the market is rising, the moving average, look at it, was almost flat here. But the moment this candle started to come up, it was now adding higher prices of rice. 38, 40, 42, right? It was adding, and then before you know it, the average value that it will give us is now increasing. Is it not? Yes. So it will now start turning up. And then that's why it can be used to identify the trend. Because it will react to price change. Okay, so there are different types of EMA. I'm not going to bore you with all of that. But just understand that the best one we like to use is the exponential moving average. And the reason is because it reacts more to recent price changes. Is that okay? It reacts more to recent price changes, meaning that it will pay less attention to what has happened in the past. If we now have the market giving us a surge like 60,000 from 30-something thousand, it will react to that 60,000 very fast, as opposed to a maybe smoothed moving average or simple moving average. That one will take time to react because it's still taking the average of all the prices. But an exponential one will turn faster. So we use, as a matter of fact, the strategy I'm giving you today is based on moving average. Okay, so we're going to use moving averages. And the reason we're starting here is because we have to start simple. Okay, so that we do something that is very easy for us to find and execute. Okay, yes, and even though it's simple, I still added a little bit of price action to make it effective, because you don't want it simple and then you are still losing, right? Yes. Yeah, so you want to have wins. Okay, so but it's simple. It's quite simple actually. And I place it on my chart and it sits inside the price. It's called an indicator. And as the name implies, it's supposed to give you a signal. It's an indicator that something is happening, is it not? So moving average indicates that the price is either going up, coming down, or staying flat.
How do we identify this signal?
No, that's not the signal you have been hearing about. It tells you what to do. The signal you have been hearing about is signal to place an order to buy or sell.
That is different from...
Yes, they are giving you signal for entry, stop loss, and target. Right? So, but this signal I'm telling you, just like normal English signal. Yes, to do something. Okay? So shows you the trend. It's very simple. Yeah. And then it's flattened out. Okay? This shows the trend. What they do is, if the dots are under, it shows that the market is buying. Right? If the dots are above, it shows that the market is in a downtrend, it's selling. Okay? So there are many of them. And like I said, if it's on the chart directly, it's called an indicator. But if it is at the base, where you know whether it's oversold or overbought, all of those things are called oscillators. Okay, so I'm going to show you some of them. Or down. So when that price is so much that it has exceeded the range it is putting into consideration, it now is not saying that this is an uptrend now. When it falls below,
Is it indicating a reversal that action?
That's here when the candle was forming, and eventually on the close it came down. It didn't throw it down. It just happens that this candle is now too big for it to be considered as a downtrend.
And even it has happened that the same candle that does that again brings it up.
Because it has reduced. When it reduces and stays within this range, it will assume that the downtrend is still continuing.
So it's correcting the
Yes,
price.
it's still tentative until the thing closes. Once the bar closes, you will now know where the last one's dot actually printed, whether it's down or up. Down. When it goes below, if the dots go below, it's showing you that the trend is up.
And this for buy.
Yes, and of course, you have to buy, but not only parabolic SAR. That's not enough, right? It's not enough.
Check your market.
Yes. You check your MACD for your strategy, Abi. Yeah. Oh, anything you say now will be launch pack. Okay, so this is what traders do with the moving average. They trade with it actually. Opposite of static. If you draw your trend line by yourself, it is static. But this is dynamic, and then you will see that the price is respecting this moving average. Is it not? The price gets to the moving average, it turns, gets to the moving average, it turns. If he comes back to it again, traders will buy. Right? There are a lot of people that trade that thing. As a matter of fact, the strategy I'm giving to you today is based on a dynamic support.
So you have to wait for it like 3 times.
Usually, at least so that you know that people are now seeing it and waiting to see that it reacts the 3rd time. Higher high. At least. Because if you want to be sure that it's a 60% chance of happening, yes, you need a trend. And you need at least 2 of such touches to know that, okay, this thing is confirmed that it is moving in this direction. But there are times where after 2 touches, it will still violate. So what do? When it gets to that area where you expect it to turn, you observe the candles. Yes. To know if there's going to be a breakout. Yes. It's simple like that. It's simple.
Within what interval? How long do you wait?
We'll get there. That your question is because now we're going to get there because if you say how long do you wait, if you're using a 1 hour chart, it means that each of the candle here is 1 hour. Is it not? So you have to wait for 1, 2, 3, 4, 5, 6, 7, 8 for about 3 days before it comes back here. Yes, now swing traders. Swing traders, you will be doing it very soon. You're going to be intraday traders, meaning you'll be using as low as 15 minutes chart. Right? Which is faster. If this is 15 minutes, it will be faster definitely. Instead of having 3 days, it will happen in 1 day because it's 4 times. Is it not? It's 4 times. Each candle, 20 MA. I will take my profit. It means that the trend is reversing. Is it not? It's a signal. When the MA crosses here and your system says buy MA crosses, the very first signal I got when I went to one market, you won't have any problem trading something like this if you have tested it and seen that you have at least a 50-50 system. At least. But if it's less than 50, it's not good. Okay? So, exceeding a particular limit. Opposition. That's what it is. Right? And then support is the opposite of that thing we call resistance in the market. So we assume that if the market finds a base somewhere, right? The market goes up, comes down, reverses from this point, and it does it twice, at least twice. That place is now important to traders. At least twice. Is now people are now looking at it. Those who trade these kind of systems will now start placing their trades and waiting for top. And the way the price moves around these 2 areas is like, I like to describe it as bouncing a ball on the floor. So it's between the floor and the roof. If it goes down, it will go up. A tree. And the branch of the tree hits your head. You turn, is it not? Yes, that's the way resistance is designed. Price reacts from it. But as we agreed, it's not forever. It will get to a point where the price will actually break, is it not? It will break. And what makes a break valid is that it's going to have consecutive repetitive bars. Consecutive, same colored bar, if you like. So if it's a bullish breakout, the candles that are going out will be consecutive. All right? If it's not, you will just see few candles mixed with the other color and then it will reverse back and go back into the channel. Okay? So please take note of yes, what I just said is this is resistance, right? The market is bound by this resistance and this support. and then eventually it breaks out. Now, to begin with, what is keeping this market inside here is a normal psychology, human psychology, that if the price of a commodity is a certain amount, if you go to the market, okay, let me give you something relatable. Let's say that whenever it gets to Christmas, a pair of jeans will be 6,000 naira, right? Whenever it gets to Christmas. Now, 6,000 naira in the market, right? In the open market, you see traders will take note that, okay, around this time, price of gin is 6,000 naira. So whenever it gets to December, it spikes to 6,000 naira, right? Now, anything from January, March, April, May, maybe the price comes down to, let's say, 4,000 or 5,000, right? And then when it gets to around 4,000 naira, once we are approaching November and entering December, it goes back up again to 5K or 6K, is it not?
Yeah.
And then after that period, what happens again? It will come down again. It might not come down as low as 4,000. Maybe it stops around 4,500 or 5,000. But it will come down to that area. And then December again, it will go up. So this is what is actually happening that we call support and resistance. All right, that's the technical word for it. But in real life, this is what is taking place. And then usually it won't stay at 6,000 forever.
Yeah.
We're going to get to a December where maybe dollar increased, and the pair of jeans that we used to buy for 6,000, we'll now be buying it for 8,000. Is it not? We'll buy it for 8,000. We buy it for 8,000. And then when you pick it up for 8,000 in December, by the time it comes back to January and maybe March and thereabout, it will come down to that 6,000. And you know what will happen? When people who normally buy 6,000 see that the price has gotten to 6,000, they will start buying. Is it not? Shop owners and all those people, they will start buying. That is now cheap. They buy and keep it to sell Easter market. Is it not? And what will happen? Do you think they are going to sell at 8,000 again? No. It will now start to have a trend, like fuel. Since Obasanjo time, fuel have had this uptrend. We don't accept a smaller price anymore. That's not a good thing to say, Abi. It has gotten to 200 or something now. I remember when it was 40 naira.
When it was 16 naira, 13 naira.
You see? Information on this thing I've given to you. Even though I've just explained it as maybe Easter and all of that, you have the market breaking this level and retesting that level. The retest is important. It is this retest that will tell you, for those that trade resistance and support, whether you are going to buy here or whether the market is going to dip back into the trading range. Do you understand? Yeah. So you're not chasing the market here. You're waiting for the market to pull back and then print something that shows you it is breaking out to the upside. Okay, so when we talk about horizontal lines in details, psychological levels, we talk about resistance, we talk about pivots, we talk about close of bars, we talk about trend lines again, we talk about all those lines, Fibonacci. I call it fascinating Fibonacci. We talk about all of them. All right, so we now look into details and then we see simple systems that we can trade. All right. So for now, just understand that this resistance you're seeing here is the place where the market gets to and turns, and then eventually it breaks. And then there's a little reversal here. But if you're not comfortable with this, connect this line here with this one, you will find another retest. The market gets to that point, they won't accept these lower prices anymore. Once the market breaks out and pulls back, that place, traders have put their trend lines here across these areas. They are waiting for a pullback. Once the market gets to that place, they buy. So usually what happens is that, look at this blue line. It's serving as resistance and also serving as support. So it means that something that is at some point a resistance to price can turn to a support. Those are the information I need to share with you on this thing. And then, of course, I said that it's vital for short-term trading. You can't think about doing short-term trading without knowing these horizontal lines. What I do is I put them permanently on my chart. Okay, I go to the daily time frame usually because they are stronger on the daily time frame. So I keep them permanently on my chart. So these are like floors in the market or tops in the market. So when I see any of those dim broken lines, I know that this is a daily time frame resistance or support. And even though I'm trading on the intraday level, so usually I keep these horizontal lines permanently on my chart. And then the only one that is very variable is the trend line. So I keep adjusting the trend line and stretching it out and waiting. But for the sake of horizontal lines, I usually do not trade them. You can trade them, it's fine, but I don't trade them.
Which one is that?
These ones.
You don't trade support and resistance.
I don't trade it as a technique for trading. I just keep it because I need to see it to know where there is a higher likelihood of price to turn. So, but I don't say there is support and resistance here, let me go and buy. Yes. So what I do is I just use it and say, okay, let's say I'm trading on this chart, and somewhere in the past there have been support and resistance happening here, like you are seeing now, right? There's support and resistance happening here. So when we now go forward, I have this line drawn permanently on my chart. So if I'm trading in the future and the market gets to that place, I will start thinking of protecting. I don't know if it makes sense to you. Protecting if I'm selling this market, right? If I'm selling this market and I see that it's approaching a support, what will support do? Support makes it to bounce, is it not? It means that it's going to bounce. So I have to protect, or at least start protecting. I'm going to teach you when we get to resistance and support how to draw a good resistance or support line to avoid having, because there are minor supports and major supports, right? You see some people, they have too many chart lines on their chart. Even indicators, they have too many indicators. It's wrong. If you are looking for a trend following indicator, one is enough. If you are looking for a trading range indicator, one is enough. Let these indicators show one thing. There's no point carrying moving average, combining it with parabolic SAR, combining it with whatever you have, alligator and all of them. Right? It's wrong. So you have to avoid it because it's a common trait among new traders. Okay, so when I get there, I will teach you there are three factors that warrant the validity of a horizontal line. Price must touch it 2 times, price must break it and break it strongly, and then price must retest. If these 3 things don't happen, I won't put the line on my chart. So when we get there, I'll teach you, and then you see examples how you can place those lines.
So these are just introductory?
Yes.
Okay.
That amount in the market. You can't buy gin for 1.5. Can't buy it for 2,000, 3,000. There was a time we used to buy it for 1.5. I bought gin 1.5. All right, so you can see now that is the psychology behind the self-fulfilling prophecy of these lines that you see, right? Because of the reality behind our everyday market. Those lines work. They actually work. Market will get there, reverse, get there, reverse, get there. And then traders will say it's triple bottom or triple top. Okay. So this is what I was telling you about. Now you can see the market bounces from this point here and this point. And then next you have consecutive bars that breaks it. And then the moment it starts to come down to as low as 6,000, people will buy. And this market might never come down to this price range again. Okay? So what are traders looking for? They are observing what happens when the market gets to that line. It's a simple thing. Once the market approaches that line, they are observing. Nobody buys here. Nobody buys here. Only amateurs. You have to buy with your brain. You buy the discount. You can't buy here. So when the market gets to this point, there are similar bars here. Why are we not interested in all of this? Because this is the level, this is the area where that thing happened. This is an undershoot. It didn't get to the line. The moment it gets to that line, traders are watching it. Indecision candle. Okay, so what happens next? We now start to see a trend bar. And of course, you go for 1:2. And the moment the market gets to 1:2, it pauses gradually. You know, if it's meant to go up, it will continue. I'll show you in details all of this. All right, so you go for 1:2 from here, it will hit your target. The profit taking here is what led to these two red bars. Okay? So, and then those of you who are, as you're going to be doing, I'm going to show you, you close 2/3 of your position at 1.5, and then you close the other 1/3 with a trail. Trail meaning the moment the market goes up, comes down, gets here, you move your stop now to this place when this high is broken. If it goes up and comes down, you move your stop. But you're not doing it now that way. You're going to do it with a 10 moving average. The market closed below a 10 moving average, you exit your 1/3 position. That way, if you find yourself in a strong trend like this or a swing like this, you're going to enjoy a good amount of it. And then usually will not have so much to lose.
Adjusting stop loss.
That is, you are carrying your stop loss to serve as a target protection. You're not adjusting your stop loss down. There's a rule. Yeah, of course, that's trailing. So I'll teach you trailing also. You're not supposed to allow the pullback to get too deep. Oftentimes, when the pullback is deep like that, it will violate the trend line and it will attract the people on the opposite side of the market. And then they start to short the market. That's what's happening to Euro USD now and GBP USD and the rest of them. So what you have to understand about the trading range is that it is showing that there is almost equal strength between the two people in question. It's like a street of bad boys. Two streets fighting against each other. Yes. Nobody. When the bulls are in charge, you see an uptrend. You know that one gang is stronger than the other one. They are pushing them. When the bears are in charge, you see the opposite of that thing happening. Yes. And the next thing I'm supposed to talk about is the break of a trend line. It happens when, if this is our boundary, you know these boys, they will put boundary. If it is our boundary, you dare not cross into it. That's the trend line. The trend line is the boundary. You dare not cross into it. So when the bad guys, the lesser gang, when their trend line is violated, there is a higher chance that the power will shift hand. Is it not? Yes. There's a higher chance. So the next thing I'm going to show you is violation of trend line. Okay, so even though the market stays in a trading range, it doesn't stay like that forever. After some time, their fence will be broken. These guys will attempt to fight them when the market is flat. Okay, there is a cycle I'm going to show you when we start TA proper on that technical analysis series. All right. So, yeah, that's a trading range. If you have a resistance and a support, you can usually get a trading range inside of it. And there are people who actually look for market conditions like this to buy and sell them. But we will avoid it, and I'll tell you how we avoid this kind of market. Generally, we use the consensus. Okay, so the consensus will help us to stay away from market that is ranging. This is, you are buying or selling somebody that is very strong. It's too risky because the pullbacks, when they come, they will be deep. And it can cancel out all your gains. Okay, so I believe the market is moving in a trend in some other charts. So let's identify those charts and trade them. Of course, more money is usually made when the market continues to move. And if the market is in a range like this, you don't know when it's going to break out. So your one thought self, you can't even trail it, is it not? Because you're not even sure if, in fact, as a matter of fact, if this is happening, it happens here, touches 1, touches 2. The next time it comes here, you are going to close out all your position at the top. You will close out all. Because it's not in a trend. So people who trade this thing, some of them use what they call harmonic patterns. You find a lot of harmonic patterns in trading ranges. Okay, so but we'll get there. I'll mention it when we get there. All right, so what we are looking for as traders is usually some sort of trend and a pullback and a breakout. Every strategy that is a trend following strategy will usually contain these 3 elements. There has to be a trend. There has to be some sort of pullback and a breakout. So if you are designing your own trading strategy, you put it into consideration that you need, if you are going to use technical indicators, you need a technical indicator that is going to depict the trend. I like to use the MACD. I like to see that the MACD is positive, and I like to see that the moving averages are fanned out and the price is above the moving average. It is a very easy way to just use your eyes and say, oh yeah, the trend is up. For pullbacks, I like to see rejections around the moving average before I buy, so that I know that I'm not buying an expensive price. So you want the market to pull back towards the moving average so that it will act like a dynamic support for you. And then you look for an entry. Because the breakout is now the bar that takes you into the trade. These things are called false breakouts. Some traders trade it. Some people will just go to where there is a range. And their strategy is the kind that is designed to steal people's money. They try to trade with the institutional traders. So what they do is, anywhere there's a swing high or swing low, they will go to that area and sell from that area or buy from that area. It's an intelligent way to trade. As a matter of fact, it is the same principle with which what's it called? It's the same principle with which we use overshoots. Because if you have an overshoot is saying touch once, touch twice, reject, and then go. That's an overshoot. Touch once, touch twice, go. Look at overshoot. You will find them. As we continue, you will find them. They are very effective. Because it's saying that the market is over, has gone too much. The only thing you just need to do is to manage your trade correctly. They are very effective. Overshoots. Okay, so yeah, so of course a trend is a series of consecutive higher highs and lower highs, and then a pullback is the resting phase of the trend, and then the breakout is the successive closure. Remember that the bar has to close. That's what I was trying to point out. The body of the candle has to exceed the line, not the wick. Yes, these things are noise. They are fake outs. If you have a case like this, you cannot say that this market has made a swing high. It's a faker. It is not correct. This is not a swing. It's not correct in the actual sense. Because the market did not exist around this price. It existed, but it was not accepted.
Or sustained.
Sustained.
That's why it's rejected.
Yes.
Retracement.
Yes, retracement and pullback. It's just different word.
They mean the same thing.
Yes.
Okay. So what that means is that the price is too high. It's just trying to correct it.
Mm-hmm.
Or it's too low. It's trying
See what is happening there. What we were taught. Elliot and the other guy. So impulse wave, corrective wave. Impulse wave, corrective wave. Impulse wave, corrective wave. Impulse wave, corrective wave is the resting phase. Corrective wave is as a result of profit taken by professionals. If the market moves from here to here, people are taking their profit. Is it not? Some people set their profit target that like when the market moves from here to here, I want to sell. That when they close their trade, if you were buying and the market goes from here to here, you sell at that point. That sell is a selling activity that is going to warrant the market to reverse. Is it not? If I close my buy order, I am selling. Because if I close the order, even though what I pressed was close, the broker presses what? Sell. He sells to someone else. Is it not? And he introduces a seller into the market. So, So what I'm supposed to show you here is that a trend line can actually be violated. Alright? It can be violated. What traders will usually do is they want to see that the market breaks out, and this is similar to, look at this line, it's slanted. If you turn this line like this and make it horizontal, you will see a trading range that broke out. Is that okay? Can you see it? If you turn this thing, 1 touch, 2 touch, 3 touch, breakout, retest, if you turn it, you're going to see this. If I carry these things now and I bend it like this, you will see that one. It's still the same psychology. Is that okay? So it's still the same good gang, bad gang fighting against each other. These guys are actually stronger and they are pushing them down. Every once in a while, these people will turn back and fight. But the stronger gang will push them again. Every once in a while, they turn back and fight, turn back and fight. Now, if the strong guys are actually very strong, they are not supposed to allow the weaker or lesser gang to violate their fence. Is it not? Because the moment they do it, people will start to think that these people are now in charge. Is it not? Then they will fight for some time and try to protect their wall. When that thing fails, it will result to a fresh trend. This is what we call major trend reversal. That is the only time you are allowed to trade a reversal. And when you take a trade like this, it is a 40% chance of happening. It's a 40% trade. 40%.
Not 60?
Because the trend has not started.
Okay.
So until you now start to have higher highs, higher lows, then it now changes to a 60% chance of happening. And you usually will not know until the market has gone to an extent. In real time, you don't know. So when the market is here, you don't know if it will work out or not. So it's a 40% system. And if you're going to buy this market, you want to take at least 2 times the size of that bar. Okay?
Then you need to talk about
Fractals. Fractals is the popular ones. Then if you like, you can use any one of them you want. Just the same way I talked about moving average, parabolic SAR, I will talk about them. Then you can choose to add it to your trading plan. Yes, you can.
Then would I be correct to say corrective way if I want to explain it? Just
Of course now.
In a layman,
No,
can
it's
I say
correct.
In an uptrend, sellers are selling. It's a corrective way. Will I be right?
If you say in an uptrend,
sellers are selling.
sellers
Are selling.
are selling.
Yes.
Buyers are also buying too.
That's a corrective way. Am I right?
The corrective wave is the sellers selling.
Okay.
Yes.
Then in a down.
But actually, from what I have explained already, the corrective wave is the buyers closing their buy order.
Okay.
Leads to a brief selling activity. Right? Yes. So when the market rests, you see that professionals are taking profit. And then when they take profit to a certain extent, the professionals that didn't join the first time will join the new trend again. Those ones will take their own money at some point, and the cycle continues until they get tired and the trend reverses. It is going down like this. You are not supposed to buy, sell here. Is it not? If anything, you should be thinking to buy the pullback if you must. Is it not? If anything. Now, what I'm saying in this second case now is different from this. You see amateurs, when the market is racing down like this, they think that this thing has gone too far. So they are repeatedly placing buy orders. That's why you find in a downtrend, you still be seeing mixture of candles. It's amateurs placing buy orders. Okay? So, and of course, if you are going to even do these things that amateurs are doing, you are doing it from a psychological level, is it not? And you are not just doing it carelessly. You are doing it from a psychological level, and you are observing the candles at that level. It is not the same thing as just firing your buy. Because you see one red. Because that's what the market will do. It will print an inside bar and take it out. Print another one and take it out. Print another one and take it out. And if you continue to keep your stops there, it will take all of them out. If you do it 10 times, it will take it out 10 times. If the market is going down, if the market is going like this, if anything, if you are scalping, you should be selling. If anything. But if you're hoping to trade correctly, when the market is rushing down like this, you are waiting for it somewhere. You are waiting for it somewhere. Some of these informations are very delicate.
So you said if after I want to trade it,
The close of a red candle. That's how to scalp.
where the confusion sometimes lies is looking at your, let's say, RSI. It's telling you it's already at
Oversold. Of course.
So that's where the confusion comes.
The RSI telling you that it's oversold is, if you are following, if you are respecting the RSI, that's fine. But if you are not respecting the RSI, it doesn't concern you. If you're a price action trader, you don't have any business with RSI. Now, if I'm going to scalp this, I'm going to sell the close of black candles. That's the red candle. Once I see that the candle is red, and it has closed, and it closed close to the low, it shows that this candle has strength and has momentum. I can scalp from here to the momentum of about 5 pips down, right? Protecting what I have decided to protect. If I'm going to take 5 pips, I'm going to also take 5 pips up here. So if this market, after printing this strong red bar, which is in a downtrend, decides to print green bars and take out 5 pips, then I'll lose the 5 pips. That's how to scalp. You can't look at the New York session, market breaks out to this side, and then the market is printing red like this, and it now manages to print one green. Right? It manages to print one green, and then you now buy. It will print a bigger red and take it out. If you do it 10 times, it will happen 10 times. That's what I'm trying to say. Yes, it's wrong. Guesswork.
Sir, please test the board.
Yes, I will. You that those days, those guys don't have electronic devices. So what they do, they look at the newspaper at the end of the day. They look at the price for yesterday, and then they will write it. Maybe the price is 50 naira. The next day they look at it is maybe 49. Then they look at it again, is let's say 52. Become 53 the next day. 53 again. 53 again, you know. Then maybe 50 or 50 again. Then becomes 55, right? So this is what they do. When they do these things, they plot their own graphs by hand. You see it? So they connect it with those lines. Now, the information they only have here, you know about Gatley 222 and all these old guys that wrote these books. They sell them in their manuscript. You know, those books, you get them, they show you how to trade just something like they have no idea what candles are. Edward and McGee, all these guys, their books are all in our resource group. Okay, so they have no idea what candles are and all of that. No excess technical. In fact, if you do too much of these, people were the people that originated technical analysis, and then when they say that there's a pattern with this price and all of this, people think that they are crazy. Because they feel that the only thing you can do in the market is to be a position trader. Trade the news, the economy, and just, you know, speculate. Now, what happened was, in Japan, there was a Japanese guy. That's why they call these bars, you see the red and the green. They call them Japanese candlesticks. There's a reason for that. They are called Japanese candlesticks because it was originated by a Japanese rice seller. It was originated by a Japanese rice seller. The guy observed that even though the news release is just a single price at the end of the day, there were many things that happened. If, let's say, this is the price of one bag of cocoa, 50,000, 49 the next day. Later it became 52. Later, you know, the bag, the prices was changing. Now the Japanese rice seller, he's a farmer. He's also a speculator. He now realized that early in the morning, it's possible that even though the actual price of a bag of rice is 28,000, very early in the morning, when people who are selling in the village come, he will sell it to them at, let's say, 25,000 instead of 28. Then those people will go to their village and sell it maybe small. At the end of the day, they will end up selling the entire bag at, let's say, 32,000. Is it not possible? It's very possible, Abi. Then the next day they will come back to the Japanese man and buy again. Right? If maybe they are going back to the farmer on the day when the farm is open for sales. If they are going back to the farmer to buy and they still have some rice left, they give it out as auction. Abi, you know how you go to the market at the end of the day and the madam will say, make I pack everything for you, just give me a certain amount. Is it not? Yes, it's possible. So maybe that day they sell at, let's say, 31. Now, do you know that at the end of the day, the only price that the news will carry is the last price? Do you understand what I'm saying? That's the only price. But look at all the activity that happened that day. And all these things are information. OHLC. They are all informations that the candles give to us that a line cannot give us. The line can only give us C, which is the close. Except you set it to give you something else. You can adjust it on your settings within your MT4. But by default, it will give you the close of the bar. Now we want more information. That is why we have candles. That's all. Candles are saying that market started very early in the morning, right? At 25. The farmer sold. He said, oh, I sold to some people at 25 actually. Then these people, when they went back to their community, they sold at 32,000. And then before the end of the day, some of them gave auction for some of those rice at 31,000. This is another representation of price. It's called bars. And what it represents is open. Okay, this is supposed to be open the way I wrote it, right? But just assume that it's correct so that you don't scatter the analogy. What we're supposed to have here is this example I said 25, is it not? Which is where it opened from. Then even though it opened at that price, it went as low as, let's say, 22k. You understand my example, right? Yes. Right? So now it opened here. This is O. Then it came as low as 22,000 L. And then it got to as high as 32,000. And then eventually closed at 31k. This is what a candle represents. Now, if I convert this to a candle, what you're going to see is from this high to where it eventually closed will be a wick. From here where it closed will be the body of the candle, all the way to where it opened here will be a body, right? And then what you have from here down will also be a wick. You see the way it works, right? So if you now come back here, you see what I have on that slide there, where it's labeled depending on whether the market went up or went down, right? The labeling can change. Observe it. High, low, close. All. This is now going to be open and close. Is it not?
No, high. No, high.
Sorry. High and close. Right?
Yes.
For a buy. Now, the reason for doing this is we want to know. Don't just tell us that it closed at 31. Who won that day? Do you understand? Who is the owner of the day? Who has the bar? Who got the 31?
Who's the buyer?
Yes, right? Because this is possible that the market, even though the newspapers reported 31, the market actually went down and stopped at 31. It's possible that the price maybe got to 38, but they didn't accept 38. Then they dragged the price down to 31. We don't have all those information. And of course, for you to make decisions, the more information you have, the more closer or the higher your win rate will be. So that is how these whole candles are formed. They reveal all those information. If not, we'll just simply use a line chart. As a matter of fact, some people will convert their charts to a line chart for certain reasons. Maybe for visual aid, to take away the noise. Some people do that. They just want to see lines. Alright? And then it's either you're using actual candles or you're using bars. This one is more convenient to look at than this. But this is also a representation. As a matter of fact, these are the three ways to represent the market. It's either you're using a line chart or a bar chart or a candlestick chart. What is very common is candles. Usually by default, I think your MT4 stays as candles. If you just install them, it will be candles. So, but you can change to bar or this. So, but that's the information you have to understand there. And again, I have to emphasize that the reason for bringing out this and translating it to this is because we want to know who owns the bar. And that's what is going to tell us whether there is a breakout or not. if I am hoping to buy from a certain level, but I see that the price, even though the price got to 32, maybe something happened. It's possible that they lifted the ban on rice. Abi, you will see that even if you bought that rice at, it can fall down to 18,000. Is it not? Because people will go and import the rice. It will fall down to 18,000. Now, if a candle is showing you that the market rose to 32,000, but eventually it got to as low as 18,000, what does it tell you? Does it tell you that that signal, if it's a trend line, and you are hoping to react from this trend line, is this a good signal to buy? No. I don't know if it makes sense to you. What you want to see is that the market was approaching your trend line or your support line, but the candle that is printing there is telling you that there is some sort of upward movement. We call it a reversal. I don't know if you process it correctly. The candle that is approaching, what I'm saying is, we have been learning since morning that if this is a trend line and the market touches it 1, 2, goes again and is about to touch it, the third time, right? You understand what I'm doing here? It touches it 1, 2, 3. It's about to touch it the third time. And you look at the candle there. And the candle is representing rejection of upper price. You can't buy this candle. Is it not? Because there's a high tendency that even though it's 18,000 today, it will still go down to 16. So what do traders do? They wait when the market gets here and they observe the candle that forms here. It's very important. I'm going to give a strategy now where we'll say, okay, there's going to be 3 moving averages. You want to see them fanned out, and then you want to see that when the candle approaches this moving average, it's showing you some sort of rejection. It's showing you some sort of rejection. There are 3 bars we're going to be using. One of them is called a pin bar. The other one is called an engulfing bar. And then the last one is called a combination of an indecision candle and a marubuzu. All these things I mentioned are reversal bars. Yes. Don't worry, you take it gradually, you will. Okay, so yeah, that's the essence of this. So that's why I took my time to explain this, is because I need you to understand how a bar is formed, and that every bar means 3 things, one at a time. Is either the bar is a bullish bar, or it is a bearish bar, or it is an indecision bar. There is no in between. When you look at a bar, if the bar is having a big amount of body that is colored green, if you set your candles that way to be green, right? It means that and it goes up. If I look at this bar, if this bar is going to be green, is it not? It will be green. And then it's a bullish bar. It belongs to the bulls. Then if I now look at this other one I talked about here, even though the market started somewhere around 25 or 22, as the case may be, it dragged it down to 18. You will now see that from here, it was green. But later in the day, it got to the opening price and went below the opening price. Now it's red. Sellers are in control. Candles like this are bearish bars. What if there's a struggle? Market goes up, goes down, goes up in the course of the day. At the end of the day, what do you get? You see that they observe that if you look at this thing here, you are going to see that it's looking like a trend. It's looking at like there's a trend. If look at this thing now. Again, this is another concept I'm showing you now. If the market is in an uptrend, like this, right? If it's an uptrend, I can translate this uptrend to a bar. What I need you to understand is that each candle on the chart is just showing you the change in price within that period of time. If my chart is a 1 hour chart, it means that each candle will take 1 hour to form, close, then the next one starts. If I change my chart to 5 minutes, it's going to take 5 minutes for one bar to form, close, then the next one will start working. If I change my chart to a daily chart, it's going to take a whole day for one candle to form. It's clear. Now, if I go to a 15 minutes chart, I'm going to see several bars, is it not? So many candles that makes up the 24 hours, Abi, which is a day. But do you know that if I open my daily chart, I will see just one candle that is forming? Are you aware? You are going to see just one candle that is still forming. It means that if it is a 15 minutes chart, I can translate the all of this to one single bar. Is it not? Yes. Now let's do that. What are you going to have here? This market opened here, went up, go down, went up, all the way. You have what we call a marubuzu. Is it not? That's a solid green bar. If I do something similar so that you can see the appearance of some wicks, you see, if let's say the market is here, it went up, came down, went up, didn't go down so much, then came like this, started to go up again, like this, and then it closed like this. Let's translate this one. Still a green bar, is it not? But I think there's going to be wicks this time, right? See where it opened. This is where it opened. So we have the body here. Look at here now. The market came down here, went back up again, and continued, right? We are having a similar scenario here too. So this is it. This is it, right? Now, what is this? It's an uptrend, is it not? What is this? Uptrend. What are these bars? We call them trend bars. So there are two types of bars. It's either it is a trend bar or an indecision bar. Indecision bar is formed from flat market. If I open the 15 minutes chart, and market is just like this, unable to make high, can we interpret this? Is it possible to have a scenario like this? Is it possible? Is it possible to have something like this on a 15 minutes chart?
On a 15 minutes chart?
Yes, for example. Or 5 minutes chart. Something like this. The same way we had this. Of course, it's possible. It's possible. It's very possible. Now, because came up to this point, and then you have something like this. What's this? It's an indecision bar. Anytime the market is in a trading range like this, the market is just going up throughout that day. And at the end of the day, you don't see a full-bodied candle that is a trend bar. So you're taking home that there are two types of bars. It's either the bar is a trend bar, and then if it's a trend bar, it's either bearish or bullish, or it is a trading range bar. It's a trading range bar. And then these bars are showing indecision. It makes sense? So you've got only two types of bars. I have another extract on that slide there where you can see different types of bars. All of them have names. If you understand this concept, you will be able to trade correctly using the bars. So all we just need to do is we go into this slide and say, okay, which one are the ones that are important to us? There's no point cramming all of them. When we get to Japanese candlesticks in the course of the course, I will talk about all of them. But if you understand this concept now, you won't struggle with any of the reason why they are the way they are. More information than a line. And when the reduction in the price during that time period, or it can just be indecisive. Those are the three things. So we can define any bar I see. Once I look at it, is either that if it's a small body bar. What makes us say small bodied bar? It's not that the bar is now like this, you now say it's small. Is that okay? It is in relative to the wicks. Does it make sense? Because what makes you say, okay, there's a rejection? It means that the market went up, was rejected, went down, was rejected. Yes, it's not that, because this can be a full body trend, but it's short like this. I don't know if it makes sense to you, so that you don't make a mistake on that. What makes it a trading range bar? Small body candles are generally trading range bars. Sometimes is a bit subjective, because you have to observe that every other bar within the same period were big, and then all of a sudden you have a very little candle. It's showing that it's a small body candle which is indecisive. But as a rule of thumb, you have it that usually the body of the candle is always about 1/3 of the entire size of the candle. What I mean by that is that if the candle is this high, we have 1/3 around here, is it not? We have 1/3 around that place. So it means that the body of the candle has to be at least that high. The size, it might not be seated at the top here. It could be at the middle. It could be at the top. Right? Of course, we want to see the rejection if we are buying down. And we want to see the rejection if we are selling up. Abi? So it could be at the middle. It could be at the top. But it's usually about 1/3. And then what you have here is the wick of the candle, which is usually about 2/3. Is usually longer than the actual body. So when you have a case like this, of course, if I try to draw a candle that looks like this, what you will see is something like this. Okay, and then this is what I was referring to as a pin bar. It looks like a pin. Sometimes it's not as big as this. It can be something like this, right? It has a wick here and a longer wick below. It's a pin bar. Sometimes it's just a single line. That one is called a doji. Like this. It's a pin bar. All of them say the same thing. They say that the market went down at some point, but they didn't like the price. They rejected it. That's what's happening here, here, and here.
Is this one also inverted hammer?
This one is the one that qualifies as inverted hammer. Because that inverted...
No, this hammer.
And this is hammer, sorry. But I thought she meant actual hammer. Inverted hammer this is hammer because it's down. So when it's up, it's called shooting star or hammer. Or inverted hammer. Inverted meaning that you turn this tail now up. Makes it inverted.
And to be bearish there.
Yeah, it will be bearish. So, but the actual name is shooting star. You understand what I'm saying, right? As this candle is now, it's called hammer. But when you now change it and it now looks like this, it's now inverted hammer. Another name is shooting star. So we are going to classify all of them, whether they are doji or hammer or whatever, shooting star. We just say all of these are called, they are indecision bars, but we'll take them as pin bars. For the sake of the strategy, I will show you. So we'll classify all of these type of candles as pin bars. Right? So I believe that at least you have an understanding of what these candles are now. Right? Now, if I combine the candles together, that's where you now start to see a trend. Right? If I combine them together, you now start to see a trend. Now, see the beauty of understanding this. You can measure the height of this candle and put your money on it. And set your target at ×2 the height. So that you make, if you reach 200 naira, you make 400 naira. You understand why we're doing this thing now? It's better. For me, it's the best. Because it's the most objective way to trade price action. Best you can do is to add the ATR. Add your ATR. Yes, just so that you don't get needlessly stopped out. But this is the right thing to do. You measure it. If it's 8 pips high, you factor in 2% or 1% of your account size into 8 pips. Then the calculator will tell you, yeah, use 0.54. You use the 0.54 and tell your broker that your stop is here. Your entry is here. And then you measure, this is 8 pips, you measure 16 pips to the upside. And then you put your target somewhere there. If the market is a favorable one, it will go and take your target and give you 400. If it's a bad one, it will go down and smash your stop. And you lose 200. If you do this, repeat it on a good system for 50 trades, 100 trades, you will be up, I can guarantee you. Because you have a system that is a trend following system and you are accepting at about 2 times your risk. You might not make money in 1 trade or 2 trades, but over time you make money.
Sorry, this illustration, the entry would be...
Chart, you take 2 pips above the bar. 2 pips above. And then 2 pips below. Factor in your spread if your broker is not good. Then you go for a target. For the strategy I'm giving you, I'm taking 1.5 as the first target because of all these additional calculations. Because if the pin bar is 8 pips, you will have some additional pips around it that will make it difficult for you to put your target directly at 6. It means that if you're risking 200, you are going to be taking like 350 or 340 or 320, which is very okay. It's better than taking 200. Because for you to take 200, it means that you are very sure, you are very extremely sure that your system is at least 60% or 55%. Yeah.
2 pips below after this.
2 pips above. On a 1 hour chart, I'll show you that strategy. On a 1 hour chart, 2 pips gap up and down. Yes. Contained in the other one. Even if this wick is longer than this one, the body is contained in it. It's engulfing. If I take my entry here, my stop will be at the base. Is that okay? This is the second bar that we'll use. So the kind of bars you want to see at the area of significance is a pin bar. If you're buying, the one that is facing up like this. If you're selling, you're looking for the ones that are down like this. The ones that are like this. If you're selling. For this one, the reverse is the case. Okay? Does the color matter? Yes. The color matters. If we are to engulf you, it means that the first person naturally is not even the same color as this person. Because this person came down and this person came up. This is red.
Okay, you mean the color
This
of
is
the two.
yes, the color of the
Yes,
two.
yes, yes. As the one you have drawn now is a bearish engulfing. The way
Well, I don't have any color on it, but if I label it as red
No.
and green, if this is red
okay.
and this is green,
Okay.
this is a bullish
Yeah.
engulfing bar. So is red became bullish. Can use it. The reason again why we use these things is because we have to factor in our stop loss into the height of the bars. If not, I will just tell you whenever the market gets to a level you are looking for, buy. Is it not? But we are technical traders and we have to try as much as we can to be objective with everything we're doing. That's the reason for this. So you got to memorize if you want to use the word, but I've tried to make you understand how these things come about. I can add these two candles to form a candle. Do you know that?
Yeah.
If I add these two, they will become this.
Yeah.
Do you understand?
So my question is, will the two bar be merged together? Because from what
On your chart, I don't know if we have. Yeah, we have bearish engulfing here. Right here. See what I mean by adding these two together. Let me use colors. Is red. It's coming down like this. Right? The price was around this area. Came down, closed here. Right? Now, the next day, when the market now started, you know, market will start from here, go down a bit, you know, and then start going up. Right? What happened? The price here have been engulfed. And what you now have is the addition of these two candles will result to these two places now have cancelled out. Is it not?
Yeah.
They've cancelled out. So what we now have is something like this, which is from here, like this. Is it not? And all of this turns to weak. This place cancels out. It's clear? Yes. So sometimes when you look at the candles, they might not stand out like this. They can come as an engulfing bar. They still mean the same thing. Yeah.
Okay, so if I look at a 15-minute chart, because like what you said. Like,
No. At every point in time, the market is forming all these bars. They are everywhere. It's not like you have to scan and scan and look. They are right in your face. It will print one of these reversal bars. Yes, the downtrend coming will end with this indecision, and then the reversal will continue with this. So we are saying that if the market is going to reverse from that trend line, let us see something like this, and not a follow-up or a follow-through of the red bars on that line. So we want to see, get to this line and give us the engulfing bar.
Okay. So for every time I open my chart, are you saying my first assignment or my first projection is to create my trending line or my what's it called?
It depends on what you're using. So
it
depends on what you're using, right? So, but the thing is, before you even start to say you are looking for these bars, you have anticipated some areas where you are expecting these bars to come and form. So, as the market approaches those areas, you are trading from that point. Sometimes you can open the chart and they are right there. Sometimes you can open the chart and they are fast.
Which is the system of me creating my reward system, my reward risk and
No, what I'm trying to say is at that instant when you open your chart, maybe in the morning, you can draw a line and then you see that, oh, this has formed, it has started going. Right? You can still open the chart and this is the one forming right now. And you are waiting. You can open the chart and the market has not gotten to the line. I'm just giving you different scenarios.
My own is, what do I do first when I open my chart?
Yes, the strategy will guide you. That's why you need a plan. So all of this information is for you to understand. Once we open the chart now, you begin to relate with all of this. And then when you start to place your trade, you won't have all these questions anymore. Then going forward, you now begin to intensify your knowledge on all these things. That's supposed to be the thing. So there is no me telling you when you open your chart, this is the first thing to do, except I am discussing a particular trading style with you. Right? So if the system says like this one I'm giving to you, it has a moving average. There are rules. You open your chart at any time, you see that these rules all align. Then you take your trade. Right?
If you're talking about the three-step type, is this
Inside
inside bar?
bar. Inside bar is the retest in the real sense. I don't know where I said it, but when you look at an inside bar is when this green form, there will be a red again beside it.
Okay, not before it.
No, not before. Inside bar is in front. An opposition bar, you will see now that immediately after this red and the engulfing bar, there will be something that is like a retest here. That's the inside bar. Indecision. We have agreed that indecision is just a trading range, is it not? Indecision is a trading range. Then we also agree that it will, after some point, break out. Is it not? And after some point, it will break out. Now, when it breaks out, it will retest, is it not? It will retest.
Okay, so the breakout is that big bar.
Yes. This is first of all the ranging bar. Then this breakout is the green bar. If I have a 15 minutes chart stretched out and I break it down to maybe 1 hour, the 1 hour bar will contain some 15 minutes bar. Is it not? And then we have indecision for that first one. The next set will form this one, the next 1 hour. Then the next 1 hour will form the one that retested. Right? So the next thing after this retest is either a resumption. When I say resumption, is the market now continues like this, or it goes down. So some traders who are very, very conservative will wait for the inside bar and then will trade above the inside bar instead of trading from the back. But the problem with this is that you miss a lot of entries, because sometimes the market can print an indecision bar and just take off. So there will be no inside bar. So it's just a matter of what works for you, really.
If it was to be a support and resistance, there will be need for that inside bar.
Of course. The only thing is, it's not like support and resistance. This is like a micro analysis of this big event. Right? This whole thing can happen in 10 months. But I'm just trying to show you in one bar that the market is the same. It's the same algos that is moving the market. So everything is designed the same way. So if the market, if this is indecision or small bodied candle, it has formed this trading range. The breakout has formed this one right here. And then the pullback to this place has formed the inside bar. So this is what we call inside bar actually, because you asked. So the inside bar is usually the pullback. So what you observe is after the inside bar, the market will try to test. This is the case where you enter a trade and the trade is trying to take your stop. If you take your stop away, you will miss that trade, right? Or if you close the trade, you miss the trade, because you wake up and find out that the trade continued.
So after this inside bar, you need to wait for another.
No, you're not even going to get to this point. It's because of our question. That's why we got to this point. The only thing you need is the first two things you have in front of my palm there.
That is the ranging bar and this.
Yes. So from here, the market takes off. I would have still explained this thing to you even though she didn't ask, because what you will be observing most times is that when your order is triggered, the market will still be delaying, but eventually it will go. Yes. Yes.
The red one. The red small candle. Does it necessarily do ranging?
Ranging. If it is a bullish engulfing bar, it doesn't necessarily mean that it must meet the criteria or criterion here I've given to you for ranging. This body can be equally big.
Okay.
I'm taking this as a trading range here because of the example I was trying to create. But if I have a body that is even as big as this, it was still engulfed. Is it not? It was still engulfed. If I interpret it, I'm going to have something like this.
Okay, so even without any wick.
Yes.
As far as the body.
It came down and it was cancelled out at an important area. These two I have showed you, they are my second best and third best. My very best is an indecision bar followed by a trend bar. That's my very best. I want to see an actual indecision bar. Indecision shows that they are struggling at that price. That price is important. If the market gets to a level and we're not seeing quick movements, it shows that buyers and sellers are fighting. That's why the market is in the trading range there. Who will win is what we're waiting for. The next hour. So we come back and look at it. Who won? If it's a trend bar, which is green, we know that after that struggle, it broke out. That's the breakout we're looking for. So from that point, you trace 1:2. That's all I have for you on bars.
Then,
Yes, please.
we have said bars can be categorized into two.
Mm-hmm.
Trending bar,
Mm-hmm.
trade ranging bar,
Mm-hmm.
or trading range bar.
Yes, you're right.
However, when we say pin bar,
Mm.
are we now trying to break any of this? Yes.
Yes, a pin bar is definitely an indecision bar.
Which is
Because what makes it a pin is that we are agreeing that the weight is on one side. Whether it's a doji, whether it's a hammer, whether it's whatever graveyard stone or any other kind of candle, we are saying that there's a little wick or no wick at all on one side, and the body is on 1/3 of the entire candle. So body is small, and that is the major criterion for having a trading range, that the body is small with respect to the wick. So in terms of categorizing, all of these are categorized as trading range bar. So, but beyond this, an indecision bar can be whether at the base or at the top or at the center. As long as after that activity, the next bar is a trend bar in favor of that candle or in favor of that reversal you want.